Hi, everybody. I'm Jeremiah, and welcome to Smart Money. Today, we're going to talk about 3 ways that you can use to pay off your mortgage fast. You know, usually we have a 30-year conventional mortgage, and we all have this mindset that if we have a 30-year mortgage, then we want to pay it off in 30 years. Listen, if you really want to reach financial independence and you want to be debt free, then you have to think of ways to get rid of that mortgage. And today, that's exactly what we're going to talk about. There are 3 ways that you can use to pay off your mortgage fast. So let's get right into it. The first way that you can use to pay off your mortgage quickly is by doing bi-weekly payments. So instead of you making monthly payments towards your mortgage, you want to change it to bi-weekly payments. This arrangement can be done with your financial service provider or your bank. They can work out this deal with you, whereby instead of you making automatic monthly payments, now you're going to make automatic bi-weekly payments. And what this does is that at the end of the year, you realize that you've made an extra monthly payment towards your mortgage, and with this method, it can cut down the term of your mortgage from 30 years to 25 years. So you can cut it down by 5 years. And also, you can save about $30,000 on interest. If you have, let's say you have a $350 mortgage, it could save you about $30,000 on interest. So let's take this example. Let's say my monthly mortgage payment is $1,500 a month. So instead of making the $1,500 a month monthly payment towards my mortgage, what I'm going to do now is to split it into two. I'm going to divide it into two, which means that I'm going to make a $750 bi-weekly payment towards my mortgage. When you multiply 1,500 by 12, you're going to get $18,000 for the year. And if you multiply $750 by 26, which is 26 weeks in a year, you're going to get $19,500. So that means you're making an extra $1,500 payment for the year mortgage payment that you've made. So this is how bi-weekly payment works. The second way of paying off your mortgage quickly is by making extra monthly principal payment towards your mortgage. So what you're going to do is that you're going to set up automatic withdrawal towards the principal balance. So first of all, you have to decide how much you want to pay towards, your principal balance. So let's take this example. If I still have a $1,500 mortgage payment, and I decide that I want to make an extra $500 monthly principal payment towards my balance, I just have to go into my bank account and set it up. It's very easy to set up. So what you do is that you set up automatic payments towards your principal balance. There's a drop down. Make sure you don't select regular. Make sure you select principal only. Because guess what? If you select regular, what the bank is going to do is that they're going to take a portion of that money towards interest and a portion of it towards the principal. What you want to do is that you want all that extra money going towards your principal balance, thereby reducing your principal balance over time. So what this does is that it reduces your principal balance. And because it reduces your principal balance, the portion for your interest is going to reduce over time. When you make a monthly mortgage payment, there's a portion of it that goes to interest and a portion of it that goes to principal. at the early stages of your amortization schedule, the portion that goes to the interest is way higher than the portion that goes to the principal. In fact, sometimes it's more than twice, the portion that goes to the principal goes to the interest. So, for example, if you are paying $1,500 a month for your mortgage payment, $1,000 will be going to interest, and $500 will be going to your principal. This is known as front-end loaded in banking, because the banks want to have their interest at the early stage of the amortization schedule. If you don't know this, sometimes you think that, it's 50-50. That's not true. At the beginning stages of your amortization schedule, majority, of your mortgage payment goes to, or a higher portion of your mortgage payment goes towards the interest portion of your mortgage, and just a little of your monthly mortgage payment goes to the principal. So that's why we want to make this extra principal payment to reduce our principal balance. Because guess what? The lower the principal balance, the portion of the interest goes down, and the portion of the principal goes up. So that's why we want to make extra principal only payment to the principal balance. If you're able to use this method, it can save you about 10 years of the term of your loan. So let's say you have a conventional loan of 30-year fixed. You can pay off your mortgage in 20 years. Instead of 30 years, you can pay it off in 20 years. And also you can save about $70,000 on interest. Let's say that the loan amount is $350. You can save yourself about $70,000 on interest. And the third way that you can use to pay off your mortgage quickly is known as velocity banking. There's a lot of terms for this kind of way of paying off mortgage, but we'll stick with the velocity banking. And what velocity banking simply means is that we're going to take a HELOC, we're going to open a HELOC account, which is known as home equity line of credit. So like a credit card, it's a revolving credit. That means that when I take the money out of that account, when I pay the money back into the account, I can reuse that money again. So before you can get a HELOC, you need to get some equity in your house. Usually the banks are going to loan you 80% of the equity in your house. So let's say that we opened a HELOC account of $20,000 and our monthly mortgage payment is $1,500. And we've decided that we're going to make an extra $500 principal payment towards our mortgage. But this time around, what we're going to do is that we're going to multiply the $500 extra payments by 12 months, which is going to be $6,000. So we're going to go to a HELOC account and take $6,000 out of that HELOC account and put it towards the principal balance. So what we're going to do is that at the beginning of the year, we are going to do a one-time principal only payment of $6,000. Guess what? If we do that payment, it's going to reduce the principal balance. And guess what? The portion of the interest from your mortgage payment is going to reduce. So now you're going to have a higher portion going towards your principal and a lower portion going towards your interest. And this can save you a lot on interest. If you're able to do this correctly, it can save you about 20 years of mortgage payments. Velocity banking, if you're able to do it correctly, if you're able to do it well, you can pay off your house in less than 10 years and you can save more than 70,000 in interest. So this is how velocity banking works. Maybe you'd be thinking that, okay, so why should I go through this whole trouble of doing velocity banking whilst I can just, do extra principal payments? It's all about saving on interest. As I always say, the two things that take money out of your pocket, interest and taxes. And if you can reduce it, you want to do that as much as possible. When it comes to velocity banking, it's about the interest that you're paying on the two loans that you have. Even though your mortgage tells you that, you have we have a 3.5% interest rate on your mortgage. It doesn't mean that on every mortgage payment you make, the interest is just 3.5% of that amount. That's not how it works. As I said, the interest payment is front and loaded. So what you're trying to do is that you're trying to reduce the interest that goes to the bank as much as possible. Because remember, when you look at your amortization schedule, if you've not, you don't know much about amortization schedule, you can look at the package that you were given at the closing of your mortgage, and there's an amortization schedule in there. You can see that they will show you the portions, and as your remaining loan to value reduces, that's when the principal balance reduces, the portion of your monthly mortgage that goes towards the interest reduces. So this is what velocity banking does for you. It's replacing a loan with a higher interest to a loan with a lower interest, which is the HELOC. Right now, interest rate is very low. HELOC interest rates are really low. You have equity in your house and you can get a HELOC and you'll be able to set up velocity banking, and you use this method, you can pay off your house in 10 years. So guys, that is all I have for you today. If you have any questions, just make sure you leave a comment, like, and share this video. And also, don't forget to subscribe. Till we meet again, take care.